Hello, everyone, and welcome to another episode of Brick by Brick presented by Parvis. I'm Sally, Director of Marketing here at Parvis, and I'm thrilled to be joined by Jaime Vilas from Security Capital MIC. Jaime will take us through Secure Capital and their unique offerings today, but before we get started, a quick disclaimer. Today's session is for information purposes only and should not be relied on investment, tax, legal, or accounting advice. Nothing presented here constitutes a recommendation or an offer to buy or sell any of the securities. A little bit about Parvis. We're a tech-driven real estate investment platform and an exempt market dealer licensed across all provinces in Canada. Our mission is to provide eligible and accredited investors with access to institution-quality real estate investments like Secure Capital, making the process smooth and accessible for everyone. For more information, please visit our website at parvisinvest.com. And with that, I'll hand it over to Jaime to kick things off. Jaime, thanks so much for joining us today.
Thank you, Sally. I appreciate it. Good morning, everybody. Super excited to be here to present our company and the opportunity for investors and exempt market dealers with Parvis. It's a new relationship, and we are super excited to start working together. My name is Jaime Vilas, and I'm one of the founders and partners in the company. I'm the Vice President of Sales and Marketing, and we've been around for 18 years. Based out of Ontario in the GTA. We started 18 years ago with no more than $5 million in mortgages, and we've grown it to just under $70 million. Over the course of 18 years. So slow growth, but really it's been a great product for our investors as we've returned 8.3% year over year, month by month. We've never missed a dividend payment, which you'll hear me say that a lot because we're super proud of that. It's really been an exciting time, even though there's been some challenging times in 2008. 2015 and 2023, COVID, those have been some challenging times. We're still here, still growing, and still providing a reliable return to our investors. So I'll start with the first slide, Sally, if you don't mind. Obviously, it's self-explanatory in regards to our company. Right? It's really our motto, which is to ensure that our investors' hard-earned money is protected, and we'll explain how we do it over the last 18 years. But it's really about preservation of capital and a steady, reliable income source for our investors. Reliability is the key. We're not looking to shoot the lights out with returns. There are other mortgage investment corporations that provide higher returns, but there can be you have to be careful when you're investing as to what are they investing in, where are they investing, are they using leverage? There's a lot of factors in investing in a mortgage investment fund. We keep it very, very simple, and I'll explain that as we go along. Just get to the next slide here. These are forward-looking statements, from our lawyers. We just have to be careful that when we're stating the fact that, we've provided an 8.3% return 18 years straight, it doesn't guarantee, we can't say it's guaranteed year over year going forward. So that's what this is. This is just a second part of this is that legally I can't use the word guarantee. We can only talk about what we've done in the past and how that can dictate the future. Just a little bit about us. Again, we started in 2007, and we funded a lot of loans, small loans. Our average loan size is $100,000. We'll explain as to why the loans are small, but we do larger loans as well, but the average size is small, and that reduces the risk for our investors as well because we have more loans, in the basket, 700 loans. It's if one loan doesn't perform, it doesn't affect the performance of the fund. We used to lend all over Canada when we first started the first 3 years. But now we're really an Ontario-based residential mortgage fund. We do some loans in Montreal because I'm originally from there, but only on the island of Montreal and in areas that I know really well. It's really a small part of our fund. It's only 5% of our fund based in Montreal. Again, this is a little outdated when we say 60 million. We're just under 70 million now. It's 68.5 million. All our focus is really short-term residential loans. So 1 year, 6 months to 1 year is the length of term. It's really a short-term solution for clients that can't or have been turned down by the top 5 banks or the B lenders in the marketplace. They come to us for consolidating debt because maybe they went through a divorce, maybe the client wants to do a quick renovation and they need some extra capital. Really short-term solutions for the client, and the idea is the mortgage broker to come to us for 1 year and then move them on to a B lender or the bank once they've completed whatever the issue was. Maybe it was too much debt, maybe it was a renovation, maybe it was construction, so on and so forth. There's a lot of reasons why, and we'll get into it later on as to why residential clients come to us. Mentioned this before, we have never missed a monthly dividend payment to our investors, so they've been super happy with us, and we'll get into how we've been able to accomplish that even in challenging times like COVID and 2023. Just to reiterate, real estate lending is what we do. Residential mortgages is really our focus. We don't do commercial. We don't do land development. We don't do construction when there has been no digging done. Like we will do construction, but only once the foundation and framing is up on a house and custom home. So we will do some construction. It's less than 10% of our portfolio, but the client has to have some skin in the game to reduce the risk for our investors. We have a lot of experience on our management team. I've been here 18 years. The 2 founders who started the company with me have been doing private mortgage lending for over 30 years. So it's a good, solid team, experienced team that really understands how to protect the investor's money. And this is a point that you'll hear a few times from me, but management and founders are heavily invested in our fund. We own just under $18 million of the fund's assets or mortgages. So, we're going to protect the client's money just the same way we look after our own money. And that's an important factor that investors, ask me all the time when we're doing presentations. So we'll move on to the next slide. The mission statement, again, you saw it on the first slide, is really a predictable, consistent dividend to our investors, while at the same time protecting or preserving their capital. So no losses have ever happened to our investors. They've never lost money with us in 18 years, which is a huge factor, and they've been enjoying that consistent dividend. Okay, so just a quick overview of our management team. Myself and Sherry, who's our CEO, has been with the company for 18 years as well. Started as the underwriter, one of our underwriters, and has consistently moved up the company. And she's now internal management and CEO, and has been huge in our ability to grow as our company and to keep our investors and mortgage brokers happy. Sasha, who is one of our founders' sons, who is now in his late 30s, is handling enforcement in our company. So, NSFs, payouts, all the processes whereby either the client, mortgage client, is paying out their mortgage, or they've missed a payment, or they want to renew with us. That's the whole enforcement client service department that Sash is handling. Leo is one of our founders, and Sam as well, who founded the company along with myself. But at this point, they are no longer involved on the daily operations, but heavily invested in the company. And they meet with us on a quarterly basis just to sort of see what the big picture is in our company. So a lot of experience is the point of this slide. Okay, so mortgage investment fund or corporation. What is it? How does it work? To keep it in simple terms, it really is a flow through, an income tax flow through company whereby any revenue that's earned by the mortgage through the interest rates charged to the consumer are flowed through to the investors and to management at a tax free tax flow through corporation. It allows us to pay our investors 8%. And our management, the way we work is we pay our investors first. And that's a massive part of this company, because you'll see a lot of other mortgage investment corporations base their performance on how they did for the month. That's what the investor is going to get. They can get 8% 1 year, 1 month, 10% the next month, 5% the next month, and so on. Whereas that's not what we do. We pay our investors first, the amount of 8.3%, and then we pay ourselves after expenses. So if we have a poor month, it doesn't reflect on the investors. It reflects on us, the management. So we have some lean months or we have some decent months. So it's not the investor who is affected by our ability to manage the fund properly. It's the ups and downs is really pushed down to us, the management company. Okay. Investment opportunity again is 8.3 compounded. So that means if your TFSA or your RSP or even your cash investment for that matter is invested with us, if you're not taking it out on a monthly basis, that dividend, then it'll grow compounded, and that grows at an 8.3 year over year, month over year, month, which you're getting a quarterly statement, and which you'll see that growth. And if you're requiring the income, which a lot of our investors do, then it comes to 8% return. We're very accountable to our investors. We're highly audited, and the Ontario Securities Commissions, as well as the commissions in Quebec, Alberta, and BC, no longer, because we're not lending there. But we're highly regulated to ensure, the securities commissions are there to protect the investors. Audited statements are done by Graywall and Guyot, a well-known accounting company that is based in Toronto, and they handle several mix auditing every year. So, and financials are available every single year to our investors. You just have to request them. So it's total transparency for our investors. Investment opportunities. So, who's this investment potentially for? It's somebody who is looking for a monthly distribution potentially. So somebody who wants to top up their income. They could be just retired. They could be a senior. They could be somebody who wants to supplement their income because they're only working part-time. There's multiple reasons why they might require a monthly distribution. Might be an investor who wants to look at somebody or a company that's established, that's been around for a long time, that shows consistency in their track record, and that's really us. It's been a long time now that we've been providing the same annual return. If an investor wants to top up their TFSAs or their RSPs, about 40% of our investors are TFSA or RSP investors. So
Mhm.
it's a big part of our um, investor base, which is just over 700 investors, by the way. A lot of them want to see that compound interest in TFSAs growing without having to pay any income tax on that. So it's a really nice part of the portfolio. Portfolio diversifier. There's a lot of clients who don't want to put all their money into just the stock market or just bonds or real estate. They look to us as kind of that alternative investment, and it can be a part of their portfolio.
Mhm.
What percentage that is determined by the exempt market rep, but it can be a really nice portfolio diversifier for sure. And really, investment is in Canadian real estate, and really it's Ontario-based real estate, which has been the largest growing market in Canada. With in the GTA, you have just over 8 million people, so there's a lot of opportunities. We really can't keep up with the amount of applications that we get, but we cherry pick and we pick the best deals for us, and what fits into our box. And we'll get into that a little bit longer later, how we do our underwriting. Flexibility with the access to their investment. What that means really is that it's one thing to invest in an exempt market product, but what if something happens in your life? Life events do happen. How do I get my money out? And with some exempt products, there's a 3-year or a 5-year hold, and you're not able to get your investment back. In this case, it's a 1-year hold only, and then after that, if you require your investment back, there's no problem. You simply have to let your exempt market rep know. They inform us, and we have up to 60 days to redeem your investment. And in that case, if you're redeeming your investment, we've never gone beyond 30 days in redeeming an investment. And in 18 years, we're very proud of the fact that we've never missed a redemption request or even been late on a redemption request. So it's a very, very accessible investment. So, life does happen. So, you can't always predict the future. Sometimes individuals want to open up a business, or they get divorced, or, death happens, life happens. So in this investment, you can simply take out your investment after 1 year. Why invest? There's a multiple reasons that we spoke about earlier, but this graph just simply shows the compounding effect. If you invested 8-9 years ago $100,000 into your TFSA, although you can only do 90 right now, but let's just use that as an example, or your RSP, with the compounding effect of 8.3, within 9 years you'd have doubled your income with us, and a lot of investors have experienced that. Very, very few redemptions in our company, just because we're extremely reliable, and we provide a lot of communication to our investors on an annual basis. They're getting quarterly statements. We reach out every quarter to make sure clients happy. They understand our performance. We provide what they call a green sheet, which shows the performance of our company. So there's a lot of communication with our investors. Really what you're investing in is a basket of mortgages, so over 700 mortgages. So even if a few mortgages don't perform in a given year, which it happens, it doesn't affect the individual investor's performance. They don't see that because there's such a large amount of mortgages. Even with one poor mortgage, the other 698 mortgages are performing. So it doesn't hurt the investor's individual return. We're very conservative in our approach to underwriting on what mortgage applications we're getting from the mortgage broker community, as to which deal we're actually looking at, which deal we're going to fund it's a conservative approach. Our loan to value, which basically means our overall value of the home compared to the loan we're providing, is under 70% of the value of the home in our overall portfolio. So very conservative. And so the investors can be sure that even in a down cycle like 2023, or COVID years, or 2008, when the market goes down, the values of the houses go down, they're still protected, the value. And then when markets go down, it doesn't mean that everybody's going to sell their home. It's the worst time to sell it. And really, unemployment and high interest rates are a bigger factor than market values going up and down. Okay. We spoke about the management, how heavily invested we are. So we believe in our own underwriting. We believe in our product. And of course, DRIP is available for RSPs and TFSAs and cash. Our mission, again, just to reiterate, I know I've said it a few times already, is a predictable and consistent dividend to our investors, with an emphasis on capital preservation. How do we do it? That's what the $1 million question is how do we actually do it? It's pretty simple, actually, and it's taken us 10 years to perfect, but really it's short-term mortgages. So why that's good is because it allows us to adjust to the economy, interest rates, inflation, and so on, our underwriting policies. Every year over year, every 6 months, we review our underwriting. Do we need to be a little more aggressive? Do we need to stay out of certain markets in Ontario? Do we need to not do condos at this particular moment? Do we need to be more aggressive? Do we need to maybe not do rentals anymore? Those are the things that we look at on a quarterly basis, and we can adjust our underwriting quickly. When you're locked into a 5-year mortgage, it's locked. Like, you can't change. So these are adjustments we can make very quickly. Disciplined underwriting. We have a multitude of aspects we look at when we're speaking with mortgage brokers and their clients as to their credit. How do they get into the problem, or what's the reasons why they need the money from us? What's the exit strategy? A lot of people don't look at exit strategy. Like, in a year from now, when the mortgage is due, how do we get out of that? And that's working with the mortgage brokers, getting a proper appraisal, getting a real estate opinion, and ensuring that our money, our investors' money, is protected. Geographic diversification. We don't just lend all our money in Toronto. There's lots of centers outside of Toronto that are really good, like Kitchener and Guelph, Peterborough and Barrie. All these populations of 50,000 plus urban centers is where we lend our money. We don't lend it in rural areas, which are really difficult to get out if we have to enforce on the mortgage, which basically means the mortgage isn't performing, the client's not paying their monthly payment that they need to pay. And so we have to enforce with legal letters, which we have an internal lawyer. And in that case, if it's a rural property, we learned a long time ago, extremely difficult to get out of those mortgages. And the wait time to sell that property is too long for us. So we don't lend in rural areas. We just don't do it. It's urban centers, population of 50,000 plus. And so you'll see that in one of the graphs here, where we lend our money. Extensive network. All that means is we have a massive mortgage broker community that sends us over 400 mortgage applications a month, and we close about 40 deals a month. So about 10% of what we see and what we review. A lot of deals aren't for us. We're very picky and very conservative. So, but it's good. That's how we provide reliable performance. Expense management, we've spoken about that before. Okay, so this gives you a better idea of where we're investing. Again, a little outdated. I do apologize. This is from March 31st. We're closer to 70 million now, and closer to 700 mortgages at this point. But average loan size, 117,000. Loan to value is under 70, as we spoke of before. The yield is 8.3. And as you can see, 95, 96% is in Ontario. 50% of that is in the GTA. The rest of Ontario is in those large urban populations that we spoke about. Quebec, we have a small 5% holding. It's really in Montreal, proper downtown Montreal. And the rest of Canada are, believe it or not, are from loans that we did years and years ago when we were lending in BC and Alberta. There's some clients that have been with us for 10 years and they keep paying us and still haven't exited with us. And really, we keep telling them to pay us out, but they just keep paying us. And until they sell their home, I guess, or the mortgage broker that they're working with gets us out, then that's why we have, I think it's about, I don't know, maybe 7 or 8 mortgages that are still left over. So small amount. Yeah, strange, but it's a fact. So what products do we have, and who are these borrowers that are borrowing the money that are like the investors investing money? That's one side of the business. They're getting their 8.3%. We're lending the money out to who? To clients, consumers who own homes and condominiums that require financing for different reasons. And so that's how the business works. Money in, money has to go out. So our products, simple, first mortgages, of course, has to be a house or a condo, one or the other. Second mortgages, which is a big component of our lending, again, has to be a house, has to be a condo, one or the other. We don't do a lot of condos that are not owner occupied, meaning the rentals. We prefer that it's owner occupied. Okay. People tend to have a bigger attachment to a house that they're living in than something they're not living in and renting out. Okay. Construction financing, we do some construction financing, but we only do it when the house is partially built. So meaning the foundation has to be in, the framing has to be in, there has to be a proper budget in place, proper appraisal, permits. We review who the general contractor is. It has to be somebody that we know and aware of, and it has to be in Jordan. So it has to be within an hour drive from our office so that we can review it in each phase of the construction. Renovation financing, client wants to finish off their basement, remodel their kitchen, $50,000-$100,000 loan, no problem. That's what we do. 6 to 12 months is our terms, rates range anywhere from 10 to 13% on a second. On a first, they're anywhere from 9 to 11. And so that's kind of how we operate. There's always a lender setup fee as well, and that's just for the risk, depending on if it's a first or a second mortgage or construction. The greater the risk, obviously the greater the lender fee and the rate. So, and it depends on the value, location, and so on. Who's our borrowers? Homeowners or condominium owners, of course. There are a lot of them that are self-employed. They can't go to the bank because they're not showing on their income taxes the same amount of money they're actually making because they're writing off a lot of their income. In Canada, we don't do a lot of new to Canada. We used to, but it's not a big for us any longer at this point. Some clients don't want to break their existing first mortgage because it's at a great rate or there's a massive penalty. So they come to us for a second, and we'll only go behind bank financing on those mortgages. But that's one of the reasons people come to us. Renovations we spoke about, of course. Debt consolidation is a big one too much credit card debt from their business that they started, or one of the spouses has lost their job and they have a lot of credit card debt, they come to us to pay off their debt. Or lastly, they don't meet the bank guidelines of getting a mortgage for whatever reason. They've changed jobs and they're making less income. Our guidelines for qualifying are, of course, more flexible than the banks. We have to be, otherwise we wouldn't be in business. So we have more flexible guidelines to qualify. So, but there has to be an exit strategy as well. We have to know that in a year from now or 2 years from now, things are going to change in your household. You're going to get a better job. You're going to rent your basement, whatever it happens to be. Your spouse is going to be back working. It has to be a reason. Okay. Okay. So this slide is really just talking about how we underwrite. How do we keep, our loan delinquencies to a minimum? We've touched on a few of these things. We really look at a number of factors. We're not just an equity lender. We are a lender who looks at the capacity of the client to pay the actual mortgage. So how are they been on their previous mortgage? How are they, currently doing right now? What's the story of this client? Are they, did they lose their job? Are they in a situation where one of the spouses lost their job? Collateral is just simply getting a proper appraisal and real estate opinion to get a true value on the home, to make sure we're lending on a true value, today's value, not 6 months ago or a year ago. We need an up-to-date appraisal. Loan to value is important for us. So 70% is the average, or 69. We do go as high as 75, but we also do loans that are at 40% or 50% loan to value. So it all balances out. Character of the client, meaning how long have they been at their work? How long have they been at their house? We don't lend on homes that they just bought the home 6 months later and they want to cash out. That's not what we do. So there's multi reasons what we look at on an application, and that's why we only fund 10 to 15% of the applications received. Of course, credit scores. We're not looking for perfect credit, otherwise we wouldn't be in business. Those are usually bankable clients, but we are looking for a reason as to why the credit's bruised right now, and what's going to change in 3 to 6 months. Risk, of course, we have an internal lawyer, so all the title insurance for each loan is done internally to make sure, all loans are covered in case of default. Of course, we have an in-house legal counsel team that makes sure that we're protected. Our investors are protected for every single mortgage that's in our basket. So 700 mortgages. Portfolio management. There's a few big things that we look at. We want to make sure that all our loans aren't just focused in Toronto. They're outside of Toronto, as we spoke about as well. No development risks. So we don't lend on land development. So, we don't lend on vacant land. It's not what we do and hope that somebody's going to build. It doesn't work like that. We wait for applications for homes, condos, or potentially a project that's already underway. They're halfway through their house and they need more money, and then we'll lend money in stages as they do finish off the home construction. We also look at making sure we don't lend too much money into one mortgage. So we're not doing $1 million mortgages or $1.5 million. Our maximum loan size is $500,000 to $600,000. That's our maximum loan size on first or seconds. Of course, if there are defaults, NSF checks, insurance delinquencies, any of that stuff, which we take very seriously, we take immediate action through our legal counsel in office and send out a legal letter just letting clients know that they've missed a payment, or that their house insurance is expired, or they changed insurance. Any of that information, it's all done internally by our legal team. Right. Okay, so what's the actual offering for investors? It's pretty simple. All our units that are bought in the fund, $1 equals 1 unit in our fund. The minimum is $5,000. We're able to raise up to $85 million. We're currently just under 70, so there's lots of room, lots of time to invest. No rush, but we'd love to speak to you about it anytime. But 5,000 the minimum, so easy entry point, especially for your TFSAs or RSPs. I mean, most people have a little more than that, but it's an easy entry point if you just want to try us out. Who's eligible? You have the accredited investor and, of course, the offering memorandum, which is the eligible investor. So there's room for anybody to invest really with us. And sometimes a lot of investors want to get into the private mortgage market, but they may not have $100,000 minimum to invest in one single mortgage for a second mortgage, or a $300,000 or $400,000 first mortgage. So this way, you're investing in a basket of mortgages with an easy entry point of $5,000, and you're still investing in the private mortgage market. Target yield we've spoken about. Accepted accounts, of course, cash, RSP, RIF, TFSAs. So lots of options. And we always talk about a dividend, but in the end, it's defined income. So it's interest income that you're taxed on, of course, but you're still taxed when you're getting a yield of 8%. So it's better than your GIC rates, right? And our closing dates, again, this is more of a technical thing. We close each investment on the first of the month. So you start receiving income right after the second of the month. Basically, you start receiving income. And I think that's it, Sally. I think, it's a simple company.
I mean, that's amazing. It seems like there's a lot of you guys are following your mission of providing reliable and consistent dividends. And it seems like you guys have 18 years of experience, which is a lot of experience within the real estate investment industry. And I'm pretty sure your investors outside of Quebec and Ontario, it's a testament to how reliable and consistent you guys have been for your investors. I wanted to close off.
Go ahead.
Sorry, I cut you off there. But I just wanted to say, I wanted to thank everyone for joining us for the Brick by Brick session today. And we hope that you found our deep dive into Secure Capital MIC very insightful and valuable, as much as I have. And Parvis is committed to connecting you with quality real estate investment opportunities like Secure Capital. So if you have any further questions or would like to connect with one of our DRs to continue this conversation to see if this investment opportunity is for you, please let us know. You can visit our website or reach out to us directly. And with that, I'd like to say thanks again for joining us on this session and hope everyone has a great day.
Appreciate it. Thank you.